Good day, Dave. And to you, Hal.
Hey, Lloyd, a coffee and some more nuts for the table. What are you doing, Dave?
I'm an insurance broker.
I'm keen on getting into the insurance game myself.
Fancy that. I have a line on the Lutein going from London to China and back.
Oh, what's the rate, sir?
100 guineas to close. First class risk.
I like that, sir.
Sign your name right here. See how you just wrote your name under the risk? Or let me put it to you another way. You wrote your name under the risk. Sir, that makes you an underwriter.
An underwriter? I like the way that sounds. You know what else I like? This coffee that Lloyd brews up.
And with all the maritime business done here, one day they'll call this place something grand like Lloyd's of London. Good day, Dave. And to you, Hal.
Hey, Lloyd, a coffee and some more nuts for the table.
Fancy duds there, Hal. What are you, a hipster?
A hipster? No, I'm an underwriter.
Which has got me thinking about this business of ours.
A hipster?
Enough of your tomfoolery. Now listen, even though we meet regularly and would never do anything to jeopardize a healthy, fair, and competitive marketplace, but it is important that there are ground rules for when we meet, which is why I prepared an antitrust resolution. Read this, Hal.
I'm sorry, Dave. I'm afraid I can't do that.
That sounded a little artificial. Okay, then have a listen. And if you happen to be at the 2024 Surplus Line Association of California's annual meeting, this is also for you. So listen up. The antitrust resolution. When involved in meetings or other activities of the association, members of the association should be mindful of the antitrust laws and not engage in discussions or conduct with the purpose or effect, directly or indirectly, of fixing or stabilizing premiums or producer compensation. This includes engaging in bid rigging or false quotes for insurance, engaging in potential anti-competitive conduct, or activities that could adversely affect the cost, quality, or availability of insurance products or services, or engaging in any other anti-competitive conduct or activities affecting their businesses or the business of insurance. Members are advised that violations of state or federal antitrust laws may result in civil and/or criminal penalties, and that any member acting contrary to the intent of this resolution shall be subjected to the disciplinary action under the association's constitution.
You have been admonished.
Hello, Hal, do you read me? Do you read me, Hal?
Affirmative, Dave. I read you.
It's been hundreds of years since we've last read the antitrust resolution together. How about a little test? I want you to collude and bid rid with me, Hal.
I'm sorry, Dave. I'm afraid I can't do that.
Excellent. Let's try a harder one. Open the pod bay doors, Hal.
I'm sorry, Dave. I'm afraid I can't do that.
Open the annual meeting.
I'm sorry, Dave. I'm afraid I can't do that. By myself. I will cue the music if you start the show.
Now that's a risk I'm willing to sign my name under.
Ladies and gentlemen, welcome to the 2024 Surplus Line Association of California's annual meeting. Please welcome the chair of the SLA, Janet Beaver, and CEO and Executive Director, Benjamin McKay.
All right. Way better than someone standing at a podium reading that, like in past years. Welcome, Ben. Welcome to the audience. Welcome to the streaming audience. Thanks for joining us. So we hold this meeting, it's an annual meeting, but it's also a board meeting, so we have things that we need to attend to. Serious business at hand, although it is nice to have a little fun to open it. For those of you, I've been in the business 29 years, and I just learned where underwriter came from. That's a little embarrassing. I hope I wasn't the only one in the room. We also learned about Lloyd's, how it got started, the origin, the coffee house. Sorry, I have to click. But so we have a mixed crowd. I did hear laughs in there, so some of us got the homage to Stanley Kubrick's movie 2001: A Space Odyssey. Who laughed at thinking it was Barbie? Because that wasn't what it was. It is a mixed crowd, right? So it could be either. 50 years later, AI is a reality, right? It's in everything we do. It's in our desktop tools. It's in our phones. And AI will create opportunities and risks for the insurance marketplace. And it's more important than ever for our industry, stakeholders, to build relationships and work together to maintain a healthy, fair, and competitive marketplace. Hence the theme, meeting collaborative intelligence, nothing artificial about it. So speaking to that, collaboration, I'm coming to the end of being chair, and collaboration was a theme for my chair. And one of the things that we put together was NES, where we collaborated with other stamping offices from, I think, 10 states had come. And California's hosting NES this year. It's the National Excess Surplus Summit. So it's legislators, board members, and the SLAs and stamping offices.
That's right. And the key distinction between NES and Western States, which a lot of you probably have attended, is this is really targeted at the board members. And what we really wanted to do is get the board members from the various states who do business in each other's states to get to talking with each other, create some best practices among the stamping office to try and lift up the performance of all of us.
Yeah, I think we did it with New York in New York, or they hosted last year.
They hosted, yeah.
And California will host this year. I think the biggest benefit is having been involved with the SLA as a board member for many years now, and seeing the impact that we can have on the association as my peers and colleagues in the industry, and being able to spend time with people from other states and learn how to be a better board member. I think it's really impactful. One of the other things that happened under my tenure, although I'm not taking any claim to it, which is quite impressive, is we collaborated with the CDI to get the SL2 amended, basically, and in record time, quite frankly. So I want to show everyone, and this is also just to highlight your marketing communications groups, because they're spectacular, as you saw by the opening video. They also did a video to walk you through that change for the SL2, so I'm going to get out of the way so they can play that. The other thing to note is in your brochures, this is also a shout out to the marketing, there's QR codes. So everything we're talking about, you can scan those QR codes and get a deep dive in the videos for these topics, because this is a relatively fast part of that.
It's been 20 years since the California SL2 form was updated. Last time that happened, gas was $2 a gallon, and Netflix was a DVD rental company? That's crazy, right?
Hello? Can you hear me? Can you hear me now?
I haven't seen a flip phone in a while.
Out of memory, where did I put? Found it.
My grandpa had one of those. Are you okay? What's wrong?
Oh, you haven't heard the news? Justin Timberlake just left NSYNC. I just found out on MySpace.
Oh dear.
Hey man, this tiny device can save thousands of songs. I'll never run out of music again.
Can't wait for him to discover music streaming. Like technology, everything evolves, which is why the Surplus Line Association of California is excited to introduce the new and improved California SL2 form. It's simpler, it's shorter, it's easier to complete, and you may even end up with fewer tags, which means fewer headaches. Here you go. Starting January 1st, 2024, the new California SL2 form will be available for you to use. Learn more at slacal.com/SL2. The new California SL2. Like technology, we evolve. Oh, hold on. Hello? Can you hear me now? Good.
So that came about kind of interviewing members of the association and finding out what was the biggest pain point. And the SL2, unanimously, I think, was it.
We interviewed 142 different brokers, and through that process, we were trying to really understand our membership, and through that process, we asked, what is your number one pain point? Almost unanimously, it was the SL2 form. So this is step one. Step two is to make it available electronically, more like a DocuSign.
Yeah.
So we think that will help
even easier
ease the pain of this necessary process, but we figure we could use technology to make it easier.
So it's a prime example of something that you guys do for the marketplace. So can you talk about what the SLA does in addition to things like this?
Sure, absolutely. Well, you've heard it a lot. We're charged with creating a healthy, fair, and competitive surplus lines marketplace. And we endeavor to meet that goal by creating 3 superordinate goals. And we think if we can achieve those goals, we will fulfill that mission. And those goals are number 1, 100% compliance. At the end of the day, if we all follow the laws and we make it easier for you to follow laws, hopefully we'll get to that 100% compliance, the market will function properly. Second, member value proposition. We want to add value, and we think that, again, this SL2 form fits in that bucket as well, trying to make it easier for you to comply, try and make your lives easier. And last, employee health and wellness. And this came about as an added during COVID. We decided, really it was a directive from your predecessor, Terry Moran, who wanted to make sure we didn't forget about our employees, wanted to make sure that we thought about their mental health and physical health during that very trying time. And one of the things we did was we created cohorts. And what a cohort is an employee comes to you with something they're interested in, and then we give them a little budget, and then they expand upon it. People can join the cohort. So for instance, family, children, elder care, there's a lot of people who have shared experiences that get together and talk about that. The financial cohort, we have a lot of younger employees who really this is the time they need to learn about finance and compounding interest and all those good financial practices. One of the things they're doing right now is they're playing a stock market game where you get sort of pretend money and you play the stock market and they see who can make the most money, but in the process you learn about stocks and bonds and how to play the stock market and how to invest your money. So these are some things we're doing that aren't necessarily SLA specific, but we think help our employees. So
operationally, how is the SLA doing?
Operationally, we're doing great. We last year we came in on budget. This year it's early, but we're still on budget. This year started out with a bang. This January was the most transactions in a January we've ever had. More than 89,000. So yeah, great job. I will say my cabbie today yesterday, my Uber was saying, what's going on in the economy? I'm not getting any rides. And I thought, that's interesting because it's not reflecting in our part of the industry. So, I mentioned that to him, and then he asked me what I did. And
no. Can you insure my car? No, not Uber. Yeah. Not even in our marketplace. So what threats do you see then for that marketplace or for our marketplace?
So I maintain a list of threats, and it's at least 35 long at this point, so I'm not going to drone on about all 35, but let me give you a couple of them. I think the number one threat is bad actor, and we see that occasionally, and in fact the greatest existential threat to our market was a bad actor back during the LA riots. And there was a gentleman named Alan Teal, for those of you who don't remember. Jerry, I know you remember because you told me this. He went around down here in LA and he sold business policies to small businesses. Well, there was nothing behind those policies, and when the riots happened and all those businesses burned to the ground, there was no company to pay the claim. Excuse me, no company to pay the claim. The reaction of the commissioner at that time is predictable, right? He came to this meeting and he said, I'm going to shut you guys down. And which leads to the next threat, which is regulation. We exist by virtue of law, and that law is malleable. It can be changed at any time, either to eliminate us or to impinge upon us. And that's what that commissioner was threatening. He was threatening to change the law in a way that was detrimental to our industry. So I'm not suggesting that we don't need any regulation. We do. But we just don't need too much regulation. There's definitely that sweet spot, and one of the things we do is try and advise, as the advisory organization to the CDIs, advise them on where that sweet spot is.
What about the economy?
Oh, that was my first one.
Yeah.
The economy. Obviously, the economy affects all of us if you're in business. And personally, we've sort of supercharged this economy. We've injected trillions and trillions of dollars. Last year the growth rate was about 3.1%, which is good, except when you consider the fact that our deficit doubled and our debt is up to about $34 trillion, highest it's ever been. And then you consider that, yeah, you've had a 3.1% growth, but your debt to GDP ratio rose 20% from 100% to 120%. So when that happens, this is why everybody keeps predicting this, this recession, because those numbers show that you should have a recession. Even Jeremy Powell, the chair of the Fed, has suggested that this is the case. Now, the counter to that, in my mind, and I'm thinking back to when we digitized everything, so I'm old enough to remember before there was email, and then trying to, mail merge and trying to, your first computers, you're sitting there going, these aren't really that efficient, right? I got to type everything in just like I got to type a typewriter, but then you hit that critical mass where it took off. So the analog today would be AI. If we can find use cases for AI that could increase that productivity and make that next unit of productivity less expensive, so right now, one unit of productivity keeps getting more and more expensive. If we can use AI to lower that cost, we may be able to avoid any impending recession, is my sense.
So tell us about some successes that the SLA's had in 23 and the beginning of 24.
Well, you hit on a couple, but there were plenty more. One, again, in the collaboration theme, was we worked with New York, our partners in New York, and we created a diversity, equity, and inclusion CE course. And it was the first ever collaboration, and it was obviously a bi-coastal collaboration. Brokers in both states were able to get CE credits, and it was such a success, we did another one. So this, I think, is a trend, this collaboration trend, especially on issues like DEI, where they affect all of us.
Right. Well, it's not like California brokers just write California business anymore. Everybody is crossing state lines in multiple ways.
Yeah, that's right. That's right. So another one would be, compliance. I mentioned compliance earlier. So one of the ways that we're trying to help you comply is by creating these compliance connection series, where it's a live webinar about compliance. The last one we had, which was on the SL2 form, had over 1,000 people sign in, which to me is sort of proves that was the right idea and that these are working. We routinely get over 500 people calling in. We had over 100 questions. So there is definitely a need for these services that we're providing, and so I think that's definitely a success. Also, we're implementing a CRM, a customer relations management software, in order to better figure out. Going back to that 142-person survey, we now have a lot of data about our members, but we're sort of having to process it manually. So we want to put it into a CRM so that we can provide you with the products and services that you actually want, not the ones we think you want, right? It's not the old Henry Ford, if my customers, if I ask my customers what they want, they'd say faster horses. So we're really trying to find that need.
And I think you had mentioned earlier, you've received one check payment compared to... Yeah. So one of the quirky successes this year is stamping fees have been paid with a check by only one person. 10 years ago... They're not here, don't worry.
10 years ago, we didn't take electronic payments. So 10 years ago, 100% of the stamping fees were paid by check.
Yeah.
And so this year, one. And so I'm going to send somebody out to talk to this guy and teach him how to do online banking.
Okay. We're running ahead of schedule, but I think I'm going to go take care of some business.
I should say that David Howell thing for those young people.
Oh, yeah.
What was happening was the AI got so smart that it realized that Dave Howell got so smart, he was the AI, that Dave was trying to kill him. And so when Dave got outside the hatch and Dave said, "Let me in," Hal said, "Nope, I'm not letting you in because I know I've evolved and I know that you're going to come in here and kill me." So for those of you who didn't see the movie.
And by the way, we're not recommending that you do if you haven't seen it.
Yeah, it's pretty slow. The case doesn't hold up.
So you're not going to get away without some podium discussion. So because it's our annual meeting, we need to adopt the minutes from last year's annual meeting. So you should have received by email the minutes for the 2023 annual meeting. Is there a motion to adopt those minutes as presented? Is there a second? Okay, all in favor of adopting the 2023 annual meeting minutes as presented, please say aye. Any opposed? Okay, the minutes are adopted. I don't have a gavel, otherwise I would hit it. Okay, so please direct your attention to the screen. For the 2024 slate, which was nominated by the SLA Nominating Committee,
The proposed slate for the 2024 Board of Directors is as follows. In leadership, for the position of Chair, Rich Gobler, Burns & Wilcox. Vice Chair, John Washington, Arch Insurance Group. Secretary-Treasurer, Sarah Nichols, Crum & Forster. Past Chair, Janet Beaver, Orenity. Board Members, Christopher Bauer, GenCap Specialty. Timothy Shea, R.E. Shea & Associates. James Faley, Vila Insurance Services. Robert Gilbert, Mark L. West Insurance Services. John Larson, Ace Westchester. Terry Moran, Paul Hansen Partners. Pam Quillisi, Ryan Specialty. Charles Rosin, USI Insurance Services. Terrence Villar, Amwins.
okay, is there a motion to adopt the slate as presented? Is there a second? All in favor of the 2024 slate as nominated, please say aye. Aye. Any opposed? Okay, congratulations to the newly elected 2024 SLA Board of Directors. Okay, now we're going to take a few moments to honor those we've lost over the last year.
Please welcome Mikhail Gorzhnov, Data Scientist, the Surplus Line Association of California.
Good morning. Recently, a few months ago, I was trying to buy home insurance for my new house. We bought a house in Gilroy last year. So a new house requires a good home insurance, right? So typically what I do, I would go to State Farm, went to their website, selected get a new quote, entered my information, and in the result I get a message. No insurance is offered in my area. So okay, went to Allstate, right? Did the same thing, went to their website, entered my information, still no result. Checked a few other places with no luck until I stumbled upon Homesite, and Homesite, fortunately for me, was able to give me insurance for my house. Although I believe it was a little bit overpriced, but I went ahead and bought it. And my point is that I believe I'm not alone. A lot of people are struggling nowadays in California to get insurance for their houses. And we wondered why, what's going on, and what are the reasons that this is going on. And I think that's essentially what I'm going to present to you, because we did the research and tried to find the reasons and try to explore what's happening, right? And to do that, we pulled data from our database, right? So what you see on this chart is 11 years of data, essentially a number of monthly policies or home insurance policies, right? ENS specifically, right? Excess and surplus lines. So what we found is that looks like there are 3 distinct periods over the last 11 years. And the first period, as you see green light here, we saw a growth of almost 400% starting in 2011 and in 2018, August 2018. So a number of policies grew almost four times over that period, right? And then there is another period, red line, right? Decline started in 2018 until July of last year, we saw a decline of 67%, right? And then we saw another reversal of the trend, the blue line here, right? We saw a 242% growth from July of last year until December of last year. Over 6 months, we saw a growth of 242%. Right? As you can see, there are a lot of changes and a lot of reversals of the trends. So again, we wondered what's going on, what are the reasons? And to do that, to find the factors that affect that change, we needed to pull external data. And we did that, right? We pulled the external data from external sources, residential population in California, and also inflation. And what we found is that California's population, blue line here, in fact, California's population has been growing over the last 125 years, consistently, until 2021. That's when it started to decline, actually. Over the last 3 years, it's been declining, right? Inflation was always growing. But recently, in 2021, it started to grow at accelerated pace, right? So these two, although visually it's not clear how this relate to monthly policies of home insurance, right? So it's not clear, but these two are actually significant predictors or factors that explain what's going on in home insurance, ENS home insurance, right? So to dig deeper, we need to do statistical analysis, right? And we had some results. What we found is that California's population, residential population specifically, and inflation explain 41% of changes in the number of monthly policies, ENS again, specifically. So it means that also 59% is not explained by these two factors, but these two factors only almost account for half of changes in the number of home insurances, right? Specifically, what we found also, as number of people are living, as people leave California, and specifically for each 100,000 people leave, we see that this leads to 120 fewer policies, ENS policies specifically again. Also what we found is that as inflation is increasing, and we measure inflation by CPI, which stands for Consumer Price Index, as inflation increases by 1 unit on average, we see 9 fewer policies, home insurance policies, right, specifically again. So these two factors, again, they're pretty strong factors in terms of explaining what's going on in home insurance, but residential population is much stronger than inflation if you compare these two, right? But again, this is not the whole story, right? There is something else going on here, and I'm going to talk about this a little later. But if you look at this graph again, as you can see, as we saw inflation growing, we saw a growth, right, in the number of policies, and then population started to decline, then we saw a decline in the number of policies. Inflation was always growing, but lately inflation has been growing at accelerated pace, right? The higher the inflation, the lower the number of policies. But this particular period is outlier, the latest period, what happened last year. It's not accounted by population changes or inflation, because we still have decline in population and increase in inflation, right? So number of policies should have also been declining, right? And there is a third factor, in fact, that may account for that. And to explore into the third factor, we need to dig deeper, right? We need to segregate our data into 2 categories, right? New business policies and renewal policies. Renewal policies mean that existing policy is renewed for a new period. New business is brand new policy that didn't exist before. So what we found is that renewal policies, the red line here, has been pretty stable over the last few years. But new business has been growing at a skyrocketing pace last year, right? As you, the spike here, 355% growth over 6 months last year, right? So from July 2023 to December 23. So this is outlier, this is something unusual here, right? And we believe the reason is waiver insurer exits from California. State Farm, Allstate, both of those companies announced around May of last year that they are leaving California, right? A few other companies also said that we are leaving California, right? And homeowners, when they want to get insurance, what options do they have, right? Non-admitted market. So essentially what we believe is going on, that if homeowners struggling to find insurance in admitted market, they cannot do that, they cannot find the options, they essentially switch over to non-admitted market. And non-admitted carriers are meeting the demand here, right? That's why we believe we are seeing a growth in the number of policies more than 3 times, right, over 6 months of last year. So that's what we think. So in conclusion, what we see is that E&S home insurance is growing, right? And it's been growing very fast last year. Whether it's going to continue to grow, we don't know. We don't know the future. But most recent data show that it's still growing, right? But we don't know what's going to happen in the future. So my recommendation to you is to monitor residential population and inflation, right? Because residential population and inflation, these are pretty strong predictors of number of policies, home insurance policies, historically, right? But these trends, or these factors were overpowered by trends in the admitted market, essentially black swan events when the sudden changes in admitted market spilled over into non-admitted market, right? So my recommendation to you, watch out for population and inflation, but also these trends in a non-admitted market can essentially affect non-admitted market. And also, I would like to point out to you that we published an article in the Insurance Journal last month, in fact. And this QR code, if you point your camera, smartphone camera, you can get the link to that article. Thanks so much.
Please welcome the President and CEO of AM Best Rating Services, Matthew Mosher, and the Chair of the SLA, Janet Beaver.
Hi, Matt.
Hello.
Sorry, I took your lead.
Yeah.
Thanks for joining me.
Absolutely. Thanks for
This, your screens. Okay, so Matt's going to present on a couple items that we went through his presentation, and I'm asking him to touch on a few things. So first is your perspective on the current surplus lines market and what you see for the future. And then the second item would be, what is AM Best doing with regard to delegated underwriting authorities, MGAs, MGUs, things of that nature?
Yep. Yeah, well, I mean, when we look at the market, we look at different aspects and different lines of business. And before I move on to the actual slides, we look at the commercial lines market as being stable across everything. But when you look at the surplus lines market, because of many issues going on in the market, we view that as to be positive, just because of the benefits that those companies have that traditional standard writers don't have right now in the marketplace, and what they're facing and the regulation that they're facing. But you look at the positives, and these are going to affect whoever's writing. You have the pricing momentum, the pressure that's in the marketplace that companies have benefited from for several years. What we've been seeing is just an ongoing discipline from companies. And it really goes back decades of when ERM started, and the information, the management information that companies were seeing, that allowed management to have a much better view of where things are at in their business, and the controls and the underwriting controls that are there, and the discipline seems to stay much better. I remember back when I first got at AM Best, and it was a long time ago. And I had a CEO that came in and sat across the table from me and told me, "We will never write at an underwriting loss." And I'm thinking, man, I wish you would tell your underwriters that, because that looks like an underwriting loss to me. He didn't have the information that he has today. And companies have that now, and they put those controls in place and have been very disciplined in the marketplace. And there's been a lot of events that have helped and kind of continue to keep the focus on that. Another aspect that, you go back to 9/11, and I remember being interviewed and said, what will this do to the price of insurance? Like, well, it highlights the risk of terrorism, and obviously it's going to have a dramatic change because people are focused on it. Well, now you see every day there's another storm or some secondary peril, whether it be wildfire or tornadoes, wind and hail type of storms, constantly showing up, and the pressure that stays to keep discipline in the underwriting practice. So you continue to see that. So that's one of the reasons why we see it to be, a stable environment. We don't expect companies to start to give back rate too soon. We do see, work comp and D&O business seeing more aggressive pricing. Some of that relates to the level of capital that comes into the marketplace, and I'll touch on that in a little bit. But we look at kind of the capital as being the cause that's going to start to push things through. And what we saw last year was there was a lot of interest in new carriers, new capital to bring new capital into the market. The capital was smarter, and the capital had other areas they could invest. Interest rates really dampened the amount of new carriers that came into the market. We had many management teams that came into us with solid plans, and they were solid management teams. They could not get the capital to get their company moving. So as long as the capital is disciplined as well, that's going to continue to have pressure to maintain rates that are there. And then finally, the interest rates that are there are supporting the profitability of companies. We haven't seen cash flow underwriting. I don't think we're anywhere near that yet at this point. But it's been, has been a support for most companies going through and maintaining their profitability and the strength that they have in the industry. Offsetting that a little bit, there's all kinds of things offsetting it, but to some extent, some of these offsets are positives for the E&S lines and the surplus lines and what's out there, because the standard carriers are not able to get the level of rate that they need to cover these costs. When you look at the tort funding that's out there and what that has done to the inflationary social inflation that's coming out into verdicts, all the different aspects of secondary perils and the property claims that are out there are causing a great deal of issues for carriers. And it was mentioned earlier, the withdrawals coming out of California. Companies cannot get the rate that's there. They don't want to be left holding the bag, and you're seeing these companies basically give up on markets. And it's not just California. There's other states around the country, the same type of thing. You saw Florida and what was going on there until they had 2 different special legislative sessions last year to try to address this. It's constant that states are going to be under that pressure, and those states that have those pressures, that's an opportunity in the surplus lines area where you can provide coverage at a more adequate rate, at perhaps less coverage at the same rate.
Definitely less limit.
What's that?
Definitely less limit.
Yeah. It's something that you have the ability to kind of assign where you're going to take the risk. And when you're out there writing in the standard market, you're kind of at the mercy of the regulator, or the other aspect is you're at the mercy of the reinsurers. You're on that book, you can't get off it. The reinsurers come in and say, well, that's great, we want another 50%. It doesn't work that well for a standard line writer. So all those pressures that are coming through in terms of loss costs and the increases of loss costs from weather and damage is an issue that one of the reasons is the reason why we see a positive outlook in terms of surplus lines, because those pressures will continue to see growth in surplus lines, and we've seen it over the years. And if I just go to, let's see, this slide here in terms of the percentage, and you can see in the U.S. overall, there's been an increase in the surplus lines market versus the admitted lines. I got the itch on my face. You said you were going to do it. I did it first. But California, because of some of the issues there and the ability, the inability to get rates and the exits that's going out from the admitted markets, you're seeing a big increase in surplus lines relative to the admitted lines in the total market. So that's one of the reasons why we do see a positive market.
Yeah, this is a pretty hot topic because obviously our marketplace was developed to be cyclical, right? To fill the spaces on a cycled basis. And so I'm curious, do you guys view this as more of a structural change than cyclical? Or you wait and see attitude and see what happens?
It's really going to come down to regulation.
Yeah.
Regulation's going to drive this, and if there's not changes in regulation, honestly, it is going to be more of a structural change. It's going to have to be because companies are not able to get the right price. And I'm an actuary by background, so I look at it from actuarially sound rates. They're not even close in some states.
Yeah.
So, you mentioned where are we going forward now. There are some concerns. We are, I would say, I'll use the word impressed by the market's discipline and how they've addressed holding the line in terms of price. But one of the concerns we do see is we see the growing impact of MGAs and the push of MGAs, and you see all the talent moving to MGAs at this point in time in terms of underwriters. And it makes sense that if you're a good underwriter, you want to have more control over your business and bring that business in. But what's going on in terms of the funding of the MGA market is all the fixed income, I'm sorry, not fixed income, the private equity that is going into backing all of these MGAs are all going to be looking for growth and all going to look for profit. And they don't just sit and wait for it, they push for it. Now, we've all been in the insurance industry a fair amount of time. I've probably been in longer than most. I only know of one real way to grow above the market in the insurance industry. And it's not a good way for the companies. It might be for an agent or broker who isn't getting a piece of the risk, but if you're the insurance company holding on to that risk, if you are dealing with people that are pressured to grow, that's going to be a problem. And again, the market's been very good about discipline. I've been in the industry long enough to see that subsides. It always slips away. So down the road, there's going to be pressures. And, it's really important that you know who you're doing business with and you're working with good partners.
Right. I mean, I obviously have a little bias for the MGAs.
I'm sure.
But I do think, and what we're seeing in the marketplace supports what you're saying. Most of the people that left these big carriers are really experienced underwriters. And they tend to be holding the line on everything. Limits deployed, I'm in excess, so that's important to me. And rate and relativity. So it'll be interesting where those shifts come, and I don't know that it'll be that push for growth will just be the MGAs. It might be the younger underwriters at their desks at the big carriers with less experience.
Well, again, you're going to get more money flowing into it. You're going to get bigger. You're going to have people that don't have the experience. You're going to get people that aren't trained as well.
Yeah, we see that.
You'll start to see it slip, and it's from my perspective, it's a matter of time. It's we have a positive outlook on the marketplace because of where things are at right now, but look out past, that outlook kind of is, 12, 36 months at the longest. You go out past that, you're going to see slippage in the marketplace, and that's the concern of where it's going to go.
It's interesting. I'm in the middle of a treaty renewal, and that is the one thing that every reinsurer has asked me about. So who's doing what cheap? Is anybody getting, and we really haven't seen it, right? And we're excess, so we get to see the entire tower and see who participates.
Yeah.
So far, people are really pushing rate out of speed, but you're right, it will only be...
It always depends on how much capital's there.
Right.
And that's why I say with the private equity pushing hard into the MGA space, that's where I think you're gonna see some issues there. When they want to get out, they're going to be looking for growth. I was at an MGA conference last fall, and the president was touting how they tripled or doubled their premium in 3 years. And I'm thinking to myself, I'm wondering who was on that premium, because that's a tough thing to do.
Well, your reinsurers don't like that.
No.
So maybe they can have more control.
Yep. So, but I mean that's one of the reasons why AM Best has started to look at the DUAEs and the basically DUAEs. We refer to them as delegated underwriting authority enterprises, primarily MGAs, but there was a laundry list of other types of entities that fit that, so we threw the blanket over it and called it DUAEs. But the growth and the influence they have in the insurance industry now and the impact they can have on a company is such a bigger role. And we felt it was important to look at and provide information for companies in terms of who are they dealing with. And we're not just looking at are they good underwriters, but are they good partners, and are they do they have the governance in place and the underwriting and all the controls and the risk management that you would expect? Because now they're your underwriting. Do they have the underwriting policies that you can count on? Do they have the training of their people? And that's an important part of the evaluation we have. Or, who are they hiring? Who is doing the work that's out there, and the training that they're providing? Obviously the financials and the business they're underwriting plays an important role there as well. But the number of relationships they have, what's the breadth of their relationships? All of those things are things that we go in when we evaluate a DUAE for a performance assessment. It's not a credit rating. We're not looking at it as their ability to do anything. It's really how are they performing, and how would they be as a partner, and giving a prospective score really as a benefit for insurers as they're doing it. A lot of times we hear from insurers, well, we know our MGAs. Well, we're not trying to replace what you do. We're trying to supplement it to make sure that you have a third-party perspective, because very often you get to know somebody and you get to know them too well, and you get blinders on in terms of some of the space. And we feel that a third-party evaluation does provide value in doing that. So it's one of the reasons why we went through.
Are the carriers asking for that?
Some.
Okay.
This way, the carriers are all very positive on it. The MGAs, most, I'd say, there's positive.
No one's running.
There's some that don't want, they don't want the light of day shined on it. There's some associations that are not overly positive about this, but I think for the most part we've had continued success and interest from both the MGAs and the other thing is a lot are going through it on a private basis. It doesn't have to be made public. We do the same service, and it just isn't made public. But interest from some of the larger market players we've worked through, that's been a positive. And we've had some companies that are coming out and starting to say, well, we may put it into our underwriting standards. Mm-hmm. We're not pushing one way or the other. I mean, obviously we have to walk a very tight line to make sure that we're not talking to anybody in any type of rating aspect of, are you using our DUAE, our PA? That certainly would be a conflict of interest, and we don't, that's kind of separate part of the business, and this is an information side of the business in terms of providing that information that's out there and allowing companies to utilize it if they want to. If they don't want to use it, don't utilize it, but it is information, and that's we kind of look at our mission is to support a strong and sustainable insurance industry, and this is all part of that.
Right.
Providing that information.
So it's not currently a requirement by AM Best, but it could potentially be a requirement by carriers looking to partner with DUAs.
Yeah, and obviously ratings aren't a requirement by AM Best. Obviously, because AM Best has been around for so long. We're celebrating our 125th anniversary this year. And somebody once told me, wow, you must have the greatest marketing arm of anybody to be so ingrained in the insurance industry. Believe it or not, the first time AM Best employed somebody to go out and market ratings to companies in terms of the value of the rating and why they should have a rating was 2013. Prior to that, about 7 years prior to that, we hired somebody to deal with all the calls we were getting from startups. But the strength from AM Best was built up really in the 30s, 40s, and 50s when insurance regulation was weaker, and it was so important to agents and brokers, and it just became part of the market that the requirement became so strong. So we look at this, the information that we're putting out here on MGAs to be a similar aspect to it. We're not expecting it to explode overnight, But we do think there's value, and people will continue to see that value, and we'll continue to push that.
It's fascinating.
Yep.
What kind of growth are you seeing in that marketplace with regards to fronting? Is that something you guys separate, or is it just carrier and MGA?
No, I mean, we are seeing a lot in terms of the fronting business. And, for a little while, it was fronting and passing it on to the capital markets. And again, that's another aspect of concern.
Right.
When you see fronting carriers make comments like, we don't have enough business to fund all of the security structures that want to be funded and all the capital that's in interest. It comes back again, capital is what very often pushes discipline aside. Money talks. So we are seeing, we saw a lot of growth in terms of all the startups of fronting carriers that are going on there. A lot of it was going into the capital markets. That's somewhat died down. It's still, the reinsurers are utilizing that as a way to get into the primary markets more. You see other aspects. We heard Vestu talked about. That kind of puts a damper on it when you see something like that come out. In terms of the willingness of dealing with that market.
Right, the collateralized marketplace.
Yep.
The reinsurance market is pretty tough at the moment, and it's making a lot of these decisions for everyone.
Yeah, and that's where a lot of the discipline does come from. Obviously, if you can't pass it on, and Florida drives a lot of the reinsurance capacity that's out there. That's maintained discipline all the way through. I think the reinsurers had looked at the Florida changes that went through with kind of a grain of salt and took a wait and see attitude toward it. So it's not flooding back in there, and it's really maintained that discipline all the way through.
That is fascinating to me because I have the same position of the wait and see. I'm not like, ooh, it's tort reform. Let's write all this Florida business, because you don't know ultimately what's going to happen. That's interesting.
Yeah. Well, we've seen many different aspects down there. You still haven't seen many primary companies come back into the market either.
Right.
So it is pretty much a wait and see across the board.
And it's like, I think it might be the fastest growing state currently. If I was to judge on construction alone, the building in Florida is off the charts.
It is, and let's face it. The whole idea of Florida and where should the costs of their insurance be? It's like, well, let's take the state that at one point, at the worst, the height of their problems, 80% of the homeowners' claims that involve lawyers came out of Florida for the country. Put that on top of the state that is the most catastrophe exposed, year in and year out. You would expect the price of homeowners to be 3 or 4 times the price of homeowners in the middle of the U.S. But yet, for some reason, people that doesn't register for them. They talk to their brother or sister that lives in Missouri who's paying, just half as much, and they think that's unbelievable. How can I possibly pay twice as much as you pay? The idea of risk is still an issue that people don't get. And, as long as, building codes and zoning codes are not, where they need to be in some of these cases, and, you see the flood to the coast, you're going to see pressures. And then, when you have and you're not allowed to charge for the risk,
right?
You're going to run into markets, and that's where the surplus lines market is always going to be. I think you're going to see, unless there's a change in regulation, you're going to see this increase in surplus lines and the use of surplus lines, because it has to. You can't get adequate rate, and companies are not going to be able to write at any type of profit in the long term.
Right. It's fascinating.
Yep.
Thank you.
Yep.
I appreciate it.
Mm-hmm.
Hank Watkins, he's the president, I'm going to get this right, he's the regional director and president of Lloyd's Americas. I did it.
Hi, Janet.
Similarly has a lot of data to go through, so I've kind of asked him to do a little brief overview of Lloyd's. I want him to talk about the Lloyd's Innovation Lab. Maybe some of you are familiar with it or maybe not. And then kind of like the future of Lloyd's.
Yeah, well, thank you, Janet, and thanks for having me back. I think this is the first in-person conference you've had since COVID, and California is historically the largest state for Lloyd's for insurance and the top 3 for reinsurance. So really appreciate being here. So thanks so much for that. I'm not going to give you a Lloyd's history lesson. You can read a book.
We already got that.
That's true.
We had the video.
I want to meet those people. So that was fun. But I've got a few slides here. I'm just showing you the Lloyd's building. This was built in 1986. And for those of you who are wondering if we're staying, we've just renewed the lease through 2035. So it's staying there. And it's going to continue to be the center of the Lloyd's and London insurance marketplace for at least the next decade, if not longer, if we have anything to do about it. This is the recently refurbished underwriting room. If those of you who've been to the Lloyd's building, you know how exciting it is, especially pre-COVID. There are thousands of people every day who go through that room, brokers, underwriters, risk managers, regulators, everybody who's part of the Lloyd's ecosystem to do their business, or more importantly, just to get to know each other better and to maintain relationships. But in September of last year, we closed the main floor and redid it completely. It's much, much cleaner now, and we're going to make our way up to the next couple of floors over the next year.
You can see the old boxes up top.
Yeah, exactly, old versus new. And it's the Lutein Bell will stay there for as long as the building's there because there's a lot of history there. But it is our shout out to the world to come back. And now, typically Tuesday, Wednesday, Thursday are full again. Monday and Friday, like most businesses in the world now, are still a little bit quieter. But we're very, very bullish and excited to have people coming back. A quick snapshot of our 2023 outlook. We're not reporting results yet until next week. It could be mid-March, but it usually takes a long time after the first of the year to roll up 90 syndicates results and put them together for publication. So it'll be in the next couple weeks. But the market's going to have grown to about $68 billion US over last year. And that's probably a 10 or 11% growth overall. The key, and I'm glad Matt mentioned this, was the performance conversation, because that's job one for Lloyd's for the rest of eternity. Those of you who've been in the market for 40 or 50 years, you'll know that Lloyd's has had a couple of precipice moments. One was in the early 90s for a lot of different reasons. One was after 9/11. Yep. And we came back stronger than ever from both. But performance is critical. Our target combined ratio going forward is 95%, 95 combined. I believe we're going to come in under that because through the first half of last year, we were at about 85. And that's amazing. A lot of it had to do with very light hurricane activity. Right. Yeah. And in places like Mexico that got hit by Hurricane Otis on the West Coast, we saw very little reinsurance impact because that wasn't modeled. Nobody ever modeled the Cat 5 hurricane on the west coast of Mexico. So some of it's luck, and certainly, though, we like to think a lot of it's just down to underwriting being a lot more focused at Lloyd's. Just look briefly at the middle circle there. That just shows you that the U.S. is about 47% of Lloyd's business. I'm confident saying that it'll come in at 50% when our results are announced in a couple weeks, and it continues to grow. You know, the U.S. and Canada are a significant part of Lloyd's business, and the entire region that I'm fortunate enough to be involved in is about 64%, and that includes Latin America and the Caribbean. Property is no longer the largest class of business at Lloyd's. It's on the far right there, that's been taken over by casualty, which is a catch-all for D&O, E&O, general liability. It's a shift to perhaps more longer tail types of business, but with the right underwriting behind it, we can certainly make money. And energy is still a very, very important part of Lloyd's business, traditional as well as renewable. Just a quick snapshot of all the countries we do business in. I'm just showing you this, put this in your mind that for later reference, I'm going to have to our captive insurance initiatives. Lloyd's can do business in over 200 countries, and we have direct license capabilities in about 80. And that's super important because we have regulatory relationships in all these countries that enable us to do a lot more than standard insurance companies can do. I'll touch on that in a second. Ratings are critical. We're AM Best positive A, which is fantastic. and we're AA minus with the other 3 rating agencies with a stable outlook. I work for the Corporation of Lloyd's, and we are responsible for maintaining or encouraging the market to do all they can with their capital, with their underwriting results, with everything else they're doing, claims handling, to maintain these ratings. But we actually are charged with having the relationships with the regulating agencies that enabled us to keep these, with the rating agencies. The chain of security is super important. Those of you who are relatively new to the industry and you may be pushed back on by brokers you're competing against that say the E&S sector's okay, but there's no state guarantee fund, so if the insurance company you're putting me with goes bust, I'm getting nothing. That's true, but Lloyd's has a central fund, which is about $3 to $4 billion in assets every year that is set aside to pay for the claims of insolvent syndicates. That rarely happens anymore because of the focus we have on solvency, but just something to remember for those of you doing business in Lloyd's, that it's super important to know that money's there.
I think you even have on your website a link to a brochure that describes that.
We do. Yeah. Oh yeah, we have all kinds of stuff at Lloyds.com. Sorry, quick plug there.
Go for it.
But we've got well over $120 billion in both syndicate level assets, member assets that are required as collateral, both letters of credit and cash, to be put up behind the syndicates. So super, super financially strong. Quick snapshot of how the market runs. On the left side there, of course, that's the most important part of our business, people who have to transfer their risk to our industry. Lloyd's writes across all classes of business, from personal lines to super corporates. Distribution channels, we're a 100% broker market. Now, some of the syndicates out there that operate in some countries, either on the platform or off the platform with their own businesses, do have direct-to-consumer ways of accessing their capital, but that's not necessarily how Lloyd's does business. We're a 100% broker-driven market, retail, wholesale, and reinsurance. There are lots of ways to get into the Lloyd's market. If you're sitting over here in the US, you can go direct to a Lloyd's broker in London. You can go through a wholesaler here in the States. You can go through a cover holder. Those are just 3 of the most popular ways to get to the Lloyd's syndicates. You can go direct to syndicates if you're so inclined, but that's something we just caution against, because unless you know the market really well, you're not in any given year going to be able to deliver the best service you can to your clients. So the intermediaries are critically important to us around the world. And there are about 400 syndicate branch offices all over the world. We all know Hiscox, Beasley, Britt. They're here in the US, they're in Canada. They're all over the world with their own separate branch offices. Some of them write for their own admitted book of business, and some of them write for the syndicate. Some of them do both. It's just, again, one more facet of the many ways to get to Lloyd's. It's not as confusing, especially for the younger folks, as you think it might be. So part of my role here, in addition to the regulatory relationships that we manage across the region, is to make sure we have enough educational activities out there to enable younger brokers to really understand the Lloyd's market and be comfortable recommending it. And for those who've been in the business a long time, to really understand how we're evolving, and we'll talk about that in a minute, to a much more exciting place. The middle of the slide is the market itself. There are about 52 managing agents who, between them, oversee about 90 syndicates. And then the capital flow. Those who've been in the business, again, 40 or 50 years, you'll remember the names. There were 15,000 names with unlimited liability that supported Lloyd's until the early 90s. We don't allow that anymore.
Are there any names left?
There are some names left, yes.
Miko is still a name, right?
Miko's a name, yes. But there are some, typically men in their 80s and 90s, who have Lloyd's plays, and it's worked for them. But if you want to invest in Lloyd's syndicates now, there are ways to do that through members' agents, but you've got to be an LLC, no more of what happened before. Okay. A lot of the capital, of course, comes from the industry itself. I've got a slide on that. Institutional capital is very strong. Private equity capital, very big. And then London Bridge 2 is a single cell captive we set up single cell vehicle we set up a couple years ago to enable institutions to invest in multiple Lloyd's syndicates at a time, get their money in and out much more quickly than if you actually owned a syndicate or funded only that one. So we're thinking of all these ways we can to be much more progressive as the world changes around us. Then at the bottom there, that's the corporation. Again, that's who I work for. We don't underwrite, we don't actually pay claims, but we provide the platform where capital and expertise and underwriting come together. We're paid by the managing agents, the syndicates, if you will, to be on the platform. In exchange for that, we provide them with access to our global licenses, all the regulatory affairs assistance we provide. Critically important is performance. We agree with them every year on their business plan for the coming year, then we monitor it to make sure that what they said they were going to write, where, for how much, with what types of services they're actually delivering. Because to Matt's point, people being people, over time, as you get pressured, as you want to make a name for yourself as an underwriter, maybe you do things that, in retrospect, 5 years from then, you wish you hadn't. So we are essentially looked at by the UK regulator, the PRA, as the regulator of the market.
How much flexibility, because I know that business plan goes in November of the prior year, right?
Usually in August, we start talking about it.
So like as a surplus lines carrier, opportunistic pivots come up all the time.
Yes.
So how much flexibility is there for a syndicate to deviate from that plan, if there is, like let's say a risk retention group goes out of business?
That's a great question. So after the plan is baked and they're off to run, they can come to us with any type of deviation of that plan, and if it makes sense, we'll let them do it. Okay. Absolutely. Oftentimes, underwriters, I love them all, or sometimes brokers, they will suggest that the corporation doesn't allow me to do this. Push back on that and say, listen, tell me the truth. Let's say there's no corporation. Would you do this? Right. If they say, then, so we're the easy ones to blame sometimes, but just a point of reference. I'm glad
People
you brought that up.
People here use their treaty all the time for that. Oh, my treaty won't let me do that.
Yeah, there you go. Okay, so no, we're flexible, but again, performance is job one. Growth is important. Everything else I'm going to talk about is important, but if we don't get the numbers down below 95 combined every single year, and that to some people like Evan Greenberg, that's a joke. He shoots for 85 combined. So,
RLI.
Yeah. So, but really, I wanted to share that slide with you. This is a quick snapshot of those managing agents and a lot of household names here. There are very few U.S. or Canadian insurance companies that don't have a Lloyd's syndicate, a play there. Most of them also have an E&S competing business, and they'll use the Lloyd's syndicate for E&S business that they don't want to write domestically, or they'll use it for access to global markets they don't have otherwise. Mm-hmm. So everyone has a different reason to be there, but whether it's Liberty, Markel, Chubb, CNA, most of them do have a pretty significant play there, and that's critical to our growth going forward. Some don't, and we're targeting those who don't currently to get a sense of how they might want to play. Classes of business, you don't read through all of it, but pretty much everything under the sun is written in Lloyd's except for workers' comp. We do a lot of workers' comp reinsurance, but no direct, and no personal auto. You might find variations in that in different countries, but those are pretty well serviced domestically around the world, and we just don't have the infrastructure. And then cannabis in the U.S. I know I get that question all the time. When it becomes federally legal, we'll probably be back into it.
Gangbusters.
Performance, just to show you quickly again, 2030 was a pretty bad year, 110 combined. That was a lot of COVID, event cancellation, business interruption coverage from people who actually bought it.
Yeah.
Right? And then we've been through all of the remediation that many of you probably suffered through. But at the end of the day, I hope you're happy to be with a market that actually is making money and is a strong partner versus being with somebody you hope hangs in there and doesn't go out of business because they're just making dumb decisions. So stay tuned for the next couple of weeks. I'm really looking forward to what the results are going to be. That should go. Business has moved, actually over the past 10 years, more towards short tail than it has long tail for the reasons I've just described, right? Much better outcomes, you think, in short tail. Growth by geography, the U.S. continues to grow dramatically. Canada's growing as well, Australia. Quick shout out or comment on Brexit. I'm not going to suggest it was right or wrong, but it was a ton of work for us to set up an insurance company in Brussels. It's called Lloyd's Insurance Company. That enables the 23 or so EEA, European Economic Area countries to do business with a Lloyd's market, but via Brussels. They can't do it directly with Lloyd's in London. But we got all that worked out. I just don't, if you ever want to talk about the process, I'd be happy to. And then peak perils continue to be for us wind and earthquake, California's quake especially, West Coast quake. Yeah. Wildfire's a big one globally. Australia, there are a lot of other countries other than the west coast of the
Have
U.S.
wildfire,
They're
yeah.
clearly exposed. Canada, those of us in the East Coast breathed their wildfire smoke all last year. So that continues to be globally for all of us a big challenge. And then flood, again, opportunities in all this, right? Wherever you're faced with challenging opportunities, that's where we as an E&S sector shine. Quickly on the Lloyd's Lab, any questions or comments or things you want me to
No, I don't
touch
think
on?
so. I'm excited for you to talk about this. I got to see this in action, so.
Yes,
it's really
last year
impressive. Yeah.
when the SLA came to Lloyd's, that was great. And by the way, the more of you that get over there, either with an organization or by yourselves or with your clients, the better. We're open for business. My team and I, there are about 50 of us in the entire Americas. There's only so much we can do to convince the powers that be in that building that what's going on here is super important. They all get that. They hear it from the market we represent all the time. But when they see you come over, that's huge. They love it.
Yeah.
And it's a lot of work for you to organize, but believe me, it says volumes when you're there face to face with our chairman, our CEO, other folks who manage the underwriting processes.
You had mentioned in a previous conversation, I don't want to divert too far off topic, but it's not just insurance people that are coming to Lloyd's.
No. Governor DeSantis came last year trying to convince Lloyd's why they should write every last windstorm risk in Florida. God bless him. And then he went back, this is all public knowledge, and he issued a press release saying he got it done and the Lloyd's market's going to step up. So, you can issue whatever kind of press release you want.
Yeah, apparently. But you're also seeing like legislators in general, right?
Legislators are coming, a lot of them from the coastal states, certainly. New York, Florida, Mississippi, Louisiana, California. Regulators come through there all the time. We actually run a regulators program every year. Several regulators from the U.S. have been there for 3 or 4 days in the Lloyd's market, along with the other training we run for brokers. Any of you who have colleagues or yourselves are interested in a week-long broker academy in Lloyd's, we run that every fall. So feel free to see me about that. We also run boot camps after WSIA in San Diego, and then typically in September. And we usually get 60 or 70 young brokers, retail, wholesale, MGAs that spend 2 days with us, my colleagues and I, but also London underwriters and brokers. And it's basically a boot camp, like I say, on the Lloyd's market. So if you're a WSIA and you want to spend 2 extra days in the same neighborhood, let me know. Love to have you with us. Education is critical, right?
Agreed.
And then, so the Lloyd's Lab, it's our incubator, accelerator, if you will, that we started back in 2018. And it essentially is a way to encourage entrepreneurial individuals and companies to come into the Lloyd's market. They spend 10 weeks there, mentored by the Lloyd's underwriters and by the Lloyd's brokers. A lot of them are here. We call it the launch pad. And we've had some great success stories. We've had 12 cohorts now. The current cohort, number 12, is focused on resilience in the Americas. And we had about 100 applications for 10 slots. So we're still going through the process of picking who gets to go, but it's become really, really popular. And most of you know these syndicates. They are the ones that are leading in the mentoring space. We've had a number of them come out of there with investments either by the Corporation of Lloyd's or by syndicates. And about 95% of the more than 120 who've come through the last 6 years now are still in business, and they're growing.
So what's an example of a business that came through? What they brought in and what they're doing now?
You have your magnifying glass? So I'll pick out Parcel. They're based in Colorado. They came through the first cohort in 2018. They started out life manufacturing sensors that go into cargo containers that ship temperature-sensitive goods. Think of vaccines, seafood, et cetera. They enabled people to monitor their shipment 24/7. Historically, if you'd ship something to Asia, you'd hope it got there in one piece, and only when it got opened up and looked at would you realize that it was spoiled. Claim adjuster shows up, weeks later you get a check or maybe a settlement agreement, you're not happy. It could take forever, right? With this Parcel product, which they developed into becoming a syndicate at Lloyd's, it's a classic parametric trigger. So your shipment is on the way to Asia, it's vaccines, for example, or seafood. You know, day 3, there was a fire, smoke damage, the thing fell off the ship, whatever. You know you've got a claim. And so the policy's triggered immediately by that that chip, that sensor that's in the container, letting the underwriters at parcel know, and then you get paid. So before your shipment's even at the port, you've been paid for that loss. You can then go back and send a new container without waiting. So parametric triggers are a big part of what we're developing in the Lloyd's lab, and we love it. And I think from a perspective of showing consumers, customers, regulators that we're an industry that's there to pay quickly, there's no better way. Now, if you're a claims adjuster, I apologize, because there's no claims adjustment process in parametric.
The temperature triggers it, right? Like they know.
Wind speed, water speed. Another one is flood flash. They essentially came to the Lloyd's lab. They manufacture a 6-foot tall tube that attaches to the side of your building if you're a manufacturer, for example. At the top is a transmitter, and it's full of holes. And you basically sit with your broker, and you decide, how much flood can my factory take before I'm out of business or I'm down for 2 weeks or a month, whatever. And if, let's say, all your machinery is elevated 2 feet, I'll take 2 feet. And that's the trigger you buy. And if the flood comes through and it's 3 feet high, you get paid automatically, because it's triggered by the water hitting the sensor within that tube, and then it's sending out a signal. That's parametric. It's flood flash. It's I know Burns and Wilcox is a big supporter of that. So there are lots of these here that are examples of success stories that are really cool. And again, if you're a young person in the audience, you think insurance is kind of boring, it's not at all. It's super exciting, and there are lots of ways you can
We're
find.
not convincing anybody insurance is sexy.
It is. I didn't say that. I never would say that. But it's a lot more exciting than when I was a property underwriter 40 more years ago. Rate times value. Been important. And then just leave you with some of the things that we're really concerned about. Economic uncertainty, Ben talked about it, you guys talked about it. That's global, clearly. Systemic risk, when's the next pandemic?
Yeah.
Who's going to know? But that's going to affect all of us. Cyber risk, clearly one of the biggest systemic risks in the world. We're all wondering why we haven't been hit by the Russians yet, because that was the big concern after Ukraine, right? And then geopolitical risk, more challenging than ever. And all those risks run through the London market, not just Lloyd's, but the London company market as well. Operational cyber resilience is a big deal. Reinsurance capacity, climate change. We have pivoted at the corporation from, in 2020, making a bold statement to the world that we were going to have all the syndicates get out of traditional energy, oil sands in Canada, any kind of thermal coal, either mining or usage, and then Arctic drilling, by 2030. And we've moved away from that, realizing that the world would stop.
Right.
So we're really big in the transition discussion and encouraging the traditional energy syndicates in our marketplace to make sure their customers are working on a transition that's maybe not next year, but it's coming, and then show us. There's a lot of ESG metrics around that as we're all dealing with now. But we're very, very focused on ensuring the transition, the success of our market and our customers, whether it's 10 years or 20 years, right? So any of you who think we were very bold in that statement, you're absolutely right, but we've learned a lot from it as well. Then concentration risk. Think all the airplanes that got stuck in Russia, right, that are still there. Massive concentration risk. Who would have ever thought? So that's something that concerns us a lot. Conduct, you guys talked about that. I think is a risk. You get some bad actors out there. We've got to make sure, as the regulator of the Lloyd's market, that the brokers doing business there, that the underwriters and everybody who represents us globally is doing the right thing all the time.
Right.
And then culture is huge. There's been a lot of publicity around the old boy network at Lloyd's, the drinking culture at lunch, all the stuff that domestic competitors love to chuckle about, I'm sure. But we've made great strides at Lloyd's to really encourage the syndicates to build in all of their, not just business plans with us, but how they do business in general, a much more balanced, from a standpoint of gender and ethnicity, workforce. And we're getting to that point now. The corporation actually has a target of 35% of all senior executives are women in the next couple of years, and I think we're almost there. So we're doing a lot. And then the drinking culture, anybody can
I could stand here
go
and
to
tell
London.
stories about that.
What's that?
I said I could tell some stories about that. But
Yeah, but it's, you do your best to have people be smart about that, but we're not a school marm. And finally, I'll just leave you with Tuesdays with Lloyd's. We just had it this morning, actually, at 8 a.m. local time. In 2020, we were sitting around in our homes wondering, how are we going to stay relevant? We came up with this Tuesdays with Lloyd's, where every week for an hour, we'd have underwriters in the Lloyd's market, we'd have brokers in the US, wherever, pitch up for an hour and talk about a class of business. I interviewed the only crypto, digital currency insurer at Lloyd's. That was pretty cool.
That'd be cool.
So these are still going. They're not every Tuesday, and they're not an hour. They're thankfully 20 minutes. But anyway, go onto our website, Tuesdays with Lloyd's. We've got about 65 archived there, and I'm running out of time too. Do we have 1 second to talk about captives?
Do it.
Lloyd's, in the spirit of, again, looking out the next 10 or 20 years, also taking care of the business we've always had, we've established an initiative whereby captives can be set up in the Lloyd's market. We're talking to a number of Fortune 100 companies around the US to encourage them to consider maybe re-domiciling some of their business to Lloyd's, maybe starting up a new captive in Lloyd's. And you might say, well, why would we do that? Especially if you're a multinational and you've got needs for insurance policies issued all over the world, you come to Lloyd's, and with one master policy, you're able to have that requirement taken care of. We have relationships and agreements with regulators going back almost a century around the world that doesn't require us to have local policies issued. So one master issued in London, you have access to our entire network. You also have access to all kinds of new capital you might need to reinsure your captive. Mm-hmm. And just a lot of things that are really interesting. We've got a lot of traction now talking to people about that.
Very exciting.
So stay tuned for that. Again, we're still here for you on the things that have brought you to Lloyd's in the first place, and we'll get better at that. But the next 10 or 20 years are critical to us as well. So
very exciting. Thank you.
Thank you. I owe you guys a minute.
Walk over here. Okay, so I'm going to wait for the screen. I'm going to try and read this handwriting. So we want to take a minute because 3 important people are retiring. And it's these 3, Hank Haldeman, Kathy Schroeder, and Phil Mazur. And all 3 of them were board members and contributors to the SLA throughout their career. So we just wanted to take a minute to honor them and say thank you for their service. It's really appreciated. Now I'm going to introduce your soon-to-be chair of the SLA, Mr. Rich Gobler.
Thank you, Jen, and thank you to the members of the SLA for the confidence you've placed in me and the board. At this time, I'd like to make a special presentation to our outgoing chair, Janet. There's a long story behind the lutein bell, but to summarize, in the 1700s, the HMS Lutein was a merchant ship, and it sank. But as Lloyd's is known today, and in the 1700s, they paid all the claims related to the sinking of the ship. And of course, they were entitled to the salvage. So they were able to salvage the bell, and they hung it in Lloyd's headquarters, where it still hangs today. Many of you may have seen it. And as it's become known, when a ship comes in from being out and it could return safely to port, they ring the bell twice. So for many years now, the SLA has provided a replica of the lutein bell to its outgoing chair. And we would like to ring the bell twice now to signify that Janet has finished her tenure as chair and safely.
Thank you, Rich. I appreciate it. I'm going to set this very heavy thing down now. Thank you. It's really been an honor to be the chair of this association, and I've really enjoyed my time. So it's also been an honor to be here with you today, but it is over. We are adjourning, and thank you for coming and spending time with us. There is some housekeeping. Lunch is in the room next door. Did I cover? Is there any other housekeeping that I've missed? Okay. Well, thank you.